Investing in high-growth ETFs is a popular strategy for individuals looking to grow their wealth over time. High-growth ETFs focus on stocks from companies with strong growth potential, often in sectors like technology, communication services, and consumer discretionary. These ETFs pool a variety of fast-growing stocks, allowing investors to gain exposure to many high-performing companies in a single investment. High-growth ETFs often pay little dividends, opting instead to reinvest their cash flow in the business to maintain their growth. Looking ahead, easing inflation and the prospect of more Fed rate cuts will likely provide upside potential in earnings for growth stocks, particularly in the technology and communication services sectors. Here are 2 high-growth ETFs which you should strongly consider. Invesco QQQ Trust, QQQ. QQQ is one of the most popular growth-oriented ETFs. It tracks the Nasdaq 100 index, which includes 100 of the largest non-financial companies listed on the Nasdaq. It has an expense ratio of 0.2% and dividend yield of approximately 0.6%. Known for its tech-heavy exposure, QQQ has consistently delivered strong returns driven by high-growth companies in technology and other innovative sectors. However, this can also mean higher volatility compared to more diversified ETFs. Invesco does offer a less costly version, the Invesco Nasdaq 100 ETF, QQQM. QQQM's lower expense ratio at 0.15% is more suitable for buy-and-hold investors. However, do note that QQQ's 30-day average trading volume is more than 17 times that of QQQM's. This is more for traders due to the higher liquidity. Schwab US Large Cap Growth ETF, SCHG. SCHG aims to track the Dow Jones US Large Cap Growth Total Stock Market Index, offering exposure to large-cap US companies with growth potential. It holds 245 stocks, including healthcare and financial companies, making it more diversified than QQQ. It features a very low expense ratio of 0.04%, thus appealing to long-term growth investors looking for cost-effective market exposure. Its dividend yield is approximately 0.4%. Looking at the comparison chart, it can be seen that SCHG outperforms QQQ in 1 year. This is mainly due to SCHG holdings having a heavier weightage in Magnificent 7 stocks as compared to QQQ. Especially Nvidia, which had an impressive growth in value this year due to AI. But looking at a longer 10-year cycle, QQQ is a clear winner over SCHG. Ultimately, both QQQ and SCHG are solid investment choices. The choice between the two ultimately depends on the exposure you want and the amount of risk you are willing to take.